Hi students, welcome to my channel once again. I'll be talking about the first chapter of the ICANN syllabus in relation to financial management. I've uploaded a video on my channel before on an interactive section with a student. I'll be giving a summary of that chapter, the content of that chapter, which is the nature and purpose of financial management. Financial management, what is it? Financial management refers to the planning, organizing, directing, and controlling of financial activities, such as procurement, utilization of funds. So it focuses on the efficient acquisition and use of both short-term and long-term financial resources to achieve the overall objective of an organization. So the three core decision areas in financial management are investment, financing, and dividend policy. So specifically, financial managers must address the following questions, and the questions include: what type of funds should be raised? Equity capital or debt capital? Which of these should be raised? Should we raise just equity? Should we raise just debt capital, or both in certain proportion? Also, what method should be used to raise these funds? Should we get a loan? Should we call for issue of shares? In which proposed investment should the funds be allocated? How much dividend should be distributed to shareholders? And more so, what level of working capital is required and how should it be financed? So, how should financial risks be identified, assessed, and managed? These are questions that the managers must address as it relates to financial management. Also, there is a need for us to look at the interrelationship between the various financial decisions. There are three forms of financial decisions which we've mentioned: investment, financing, and dividend decisions. So the three core financial management decisions, which include investments, financing, and dividend decision, are closely interrelated. So an increase in dividend reduces the amount of retained earnings available to the organization. So this in turn creates a greater need for external financing to support capital investment projects. So similarly, an increase in capital expenditure raises the organization's demand for funding, and one potential internal source of finance is the retention of earnings, that is retained earnings, which can be achieved by reducing dividend payouts. So this is in line with the dividend decision. Also, there is need for us to look at the relationship between financial management and financial accounting. So financial accounting can significantly influence financial management in several ways. For example, directors of public quoted companies must consider how financing decisions impact published financial statements. For example, leases with duration exceeding 12 months may increase reported financial gearing, so defined as the proportion of debt financing relative to equity. So this affects the company's financial risk profile. Also, directors must assess the impact of investment decisions on key financial ratios, such as return on capital employed, which is critical for evaluating the efficiency and profitability of capital utilization. So these are the relationship between financial accounting and financial management. You can watch my earlier video on this for more explanation. Also, the relationship between financial management and management accounting. Management accounting plays a vital role in supporting financial management by providing relevant, timely, and detailed information for decision making. For example, the budgeting process can highlight potential cash surpluses or deficits, and this will enable the financial manager to plan appropriately, either by arranging financing or identifying investment opportunities. Also, management accounting deals with the classification of costs into fixed and variable components, and this assists financial managers in making informed decisions regarding pricing, cost control, and operational efficiency. More so, the management accountant performs variance analysis. So variance analysis provides insight into deviations from planned performance, allowing financial management managers to monitor, control the costs of new or ongoing projects. So also, talking about financial objectives. Financial objectives. Talking about financial objectives, there are quite a number of objectives that an organization must set. The key financial objectives commonly pursued by organizations include the maximization of shareholders' wealth, profit maximization, earnings per share growth. When we talk about maximization of shareholders' wealth, this involves increasing the overall value of the firm as reflected in the market price of its shares. So, this help in enhancing the wealth of shareholders over the long term. So, we also have profit maximization. Profit maximization, these focus on achieving the highest possible profit within a given period. So this serves as a primary measure of financial performance. Also, another financial objective is earning per share. This aims to increase the amount of profit attributable to each outstanding share, and this signals improved profitability and financial health to investors. Now, talking about maximization of shareholders' wealth. In theoretical terms, a single corporate objective is assumed, and this is the maximization of shareholders' wealth. So, shareholders' wealth is a combination of dividend and share price growth, which together are referred to as total shareholders' return. So, to compute total shareholders' return, we have a formula which is year-end share price less share price at the start of the year plus dividend per share divided by share price at the start of the year multiplied by 100. So when you do this, you determine your total shareholders return. Determine our total shareholders return. So also, still on maximization of shareholders wealth. Maximizing shareholders wealth is widely regarded as a fundamental objective of financial management, and it is justified for several reasons. One is access to capital and growth opportunities. So companies that deliver high returns to investors are better positioned to attract new capital because this facilitates future growth and expansion, and this makes it easier for such companies to compete and thrive. So also, another justification for maximizing shareholders' wealth is efficient resource allocation. Efficient resource allocation. So firms that maximizes shareholders' wealth contribute to the optimal allocation of resources within the economy. So capital naturally flows towards the business that use it most effectively, and this enhance overall economic growth. productivity. So also there is another objective, which is market discipline and customer satisfaction. Companies generating strong returns are typically those that satisfy customers' need effectively. So this helps shareholders' wealth maximization, aligns with the broader economic health and consumer welfare. So also there is a case of defense against hostile takeover. So firms that fail to deliver adequate returns may become vulnerable to hostile takeovers, and as underperformance signals mismanagement or inefficient use of resources. So these are justification of maximization of shareholders' wealth. And also there can be a case of fiduciary or fiduciary duty of directors. So directors are legally obligated to manage the company in the best interest of its shareholders. So since most shareholders, particularly institutional investors, are assumed to prioritize wealth maximization, these objectives as principle. So also, to look at an illustration in relation to total shareholders' returns, there is illustration involving total shareholders' returns and changes in dividend and share price. These examples I've put forth that SYZ purchased 100 shares in Temi at the beginning of 2024 at the market price of 10 naira per share. During the year, the investor received a dividend of 1 naira 20 kobo per share, and by the end of 2024, the shares had an ex-div market value of 12 naira 90 kobo per share. Question is, calculate the total shareholders' return. S-div means excluding dividend, while cum-div means including dividend. So total shareholders' return by the formula year-end share price less share price at the start of the year plus dividend per share divided by share price at the start of the year multiplied by 100. From the question, these various variables are clearly put. Now the year-end share price is given as 12 naira 90 kobo less the share price at start, which is 10 naira, plus the dividend per share, which is 1 naira 20 kobo, divided by share price at start. When you solve for this, you're going to have the total shareholders' return to be 0.541 or 41%. So also, the total shareholders' return is made up of two components. And what are these two components? They include capital gain and dividend yield. Now, to solve for capital gain, it's year-end share price less share price at start of the year divided by share price at start of the year. So that is the change in share price is the capital gain. And from the question, the capital gain will be 12.90 minus 10 divided by 10, and we have it as 29%. So this is a proportion of the total shareholders' return, and the dividend yield is what? The dividend given in the question, which is 1.20 divided by share price at the start of the year, which is 10 multiplied by 100, going to have 12%. So when you add these two values together, you're still going to have 41%, which is to tell you that the total shareholders' return is a makeup of capital gain and dividend yield. So also the objective of maximizing shareholders' wealth. Why do we need to maximize shareholders' wealth? The justification for maximizing shareholders' wealth. The company which provides the highest returns for its investors will find it easiest to raise new finance and grow in the future. So this should ensure the optimal resource allocation within the company and maximize the overall wealth of action. And also, the directors have a legal duty to run the company on behalf of the shareholders. It is generally considered a reasonable assumption that the shareholders of listed companies will have to rely on the directors for them to run the organization on their behalf. I've stated this earlier on. Now, there are some criticism of maximizing shareholders' wealth. While maximizing shareholders' wealth is a widely accepted financial objective, it faced some criticism, and one of it is neglect of market imperfections. In imperfect markets, particularly in monopolistic or oligopolistic settings, maximizing shareholders' return may not align with public interest. For example, monopolies focus solely on profits, and these profits is as a result of high prices, and these harm consumers and distort market efficiency. Also, another criticism is disregard for social responsibilities. The focus on financial returns often overlooks broader societal needs such as healthcare, education, even environmental sustainability and community welfare is neglected. So companies that prioritize profit above all else may underinvest in initiatives that benefits the public good. Also, another criticism is exclusion of other stakeholders. Other stakeholders. In my earlier discussion, I define stakeholders as those that have interest in an organization, those that have a stake in an organization. And the total shareholder return emphasizes the interest of shareholders at the expense of other key stakeholders. So these key stakeholders, such as the employees, customers, suppliers, and the society at large, these narrow focus can lead to decisions that undermine long-term value creation. So employee morale, customer satisfaction, and corporate reputation can be hampered. So also, another financial objective is a profit maximization. Profit maximization. So, while profit maximization, particularly in the form of maximizing total shareholders' return, is often regarded as a core financial objective, many companies find it difficult to implement in practice due to certain reasons, which include market influence on share price. So for listed companies, share prices are frequently affected more by market conditions such as economic trends, investor sentiment, and global events. So this affects listed companies than by companies' actual financial performance. So this makes it challenging to link managerial decisions directly to share price movement. Also, lack of market valuation for unlisted companies. In the case of private or unlisted companies, there is no publicly quoted share price to monitor or maximize. So as a result, measuring shareholder return becomes more complex and subjective. So this limits the application of total shareholders return as a performance measure. So also, still talking about profit maximization is also used as a proxy for shareholders wealth maximization. Though profit is not a reliable proxy, so excessive pressure to maximize profit can lead to manipulation of data and in extreme cases fraudulent accounting such as creative accounting, window dressing of financial statements just to make the profit look pleasant to the shareholders. Also, accounting profits reports debt financing cost, that is interest expense, but not equity financing costs. So this reported profit can therefore be maximized by using zero debt in the company's capital structure, because the capital structure of some organization consists of debt and equity. However, the company will then pay more tax as it loses the benefit of tax allowable interest expense. So debt is a cheaper way of financing, because an organization that uses debt we enjoy tax savings or tax shield, unlike when it uses equity solely. So also, another financial objective is the earnings per share. The earnings per share. The earning per share. The focus on earning per share is that this is a measure of the profit after taxation per equity share. So during the course of the financial year, the financial objective might be to increase the earnings per share each year and possibly to grow earning per share by a target amount each year for the next few years. So to compute earning per share, it is profit after tax less preference dividend divided by weighted average number of shares in issue. So the focus on earning per share. Earning per share can create significant pressure on management to meet analyst expectations, often at the expense of long-term value creation. So since earning per share is based on accounting profit, it inherits many of the limitations and distortions associated with traditional profit measures. So earning per share can be artificially enhanced through cosmetic measures such as share consolidation, where multiple existing shares are replaced with fewer new ones. So while this improves the earning per share figure, it does not reflect any real improvements in the company's underlying performance. So also, earning per share can also be legitimately increased through share buyback programs, where a company uses surplus cash to repurchase and cancel a portion of its outstanding shares. However, research indicates that directors sometimes initiate buybacks for personal gain. So the announcement of a buyback typically leads to a rise in the share price and thereby increasing the value of any shares or share options held by executive. That is, especially those awarded through executive share option schemes. So these are things we need to take note of as it relates to the first part of the financial management syllabus. If this is your first time of coming across my channel, and do well to like, share, and subscribe to my channel. Thank you for watching.